If you're going to be using home equity in your settlement of your divorce case, then that changes the affordability equation on whether it makes sense to keep the current first mortgage. So if you're going to be if you're going to keep the current mortgage, if your lender allows you to do that, and you have to use home equity, then that's typically going to be done through either a home equity line of credit or a fixed rate home equity loan. Those typically go to like 20 or 25 years. And so those rates are going to be based on prime. Prime right now is like 8.5, and then there's going to be a margin attached to it. So depending upon your credit score, depending upon the loan to value, it could be prime plus 1, prime plus 2, prime plus 3. So that's going to put the rate on that second mortgage between 9 and 12%, depending upon your qualification. So when you have that, if you have a first mortgage at 3.5 and a second mortgage at 10.5, depending upon the amount of that second mortgage, it might make sense just to combine them at a much higher even though the first mortgage is at a higher rate. So I use this software. It's like a financial planning software for your mortgages. So you can kind of see, we can put these numbers together so you can get a good comparison of what those different options are going to look like and how they're going to impact your cash flow so that you can make a more informed decision. So this is a case kind of just to illustrate the point. So in this particular example, the house spouse, let's call them, house was worth $500,000. They owed on it $150,000, and there had to be about a $160,000 buyout, is what they kind of calculated in their mediation case. Now, so if you look at here, the current mortgage, along with adding a second mortgage, so that puts it right around $310,000. If you click on more info up here, you can see the payment on their current first mortgage, if they keep that, is going to be $902. The $160,000 second mortgage payment's roughly around almost $1,500 on that. So that gets you to a total payment between the first mortgage, the second mortgage, taxes, and insurance of around $2,877. Now, if we combine them into a first mortgage and just combine them into a new mortgage, you can see the blended rate here is 6.1% for the current. The new mortgage with 1 point at the time was 6.99%, but it was still, it was $26.28. So it's about $249 a month less than keeping the current mortgage and going out and getting a second mortgage at a much higher interest rate. If you paid 2 points, that drops the payment down to $25.43, which is $334 less. Paid 3 points, drop it down to 6.25. It's $367 a month less. So while this is still a less expensive loan, the total cost of this is going to be less. The payment is going to be a lot more than the other options. And for a lot of folks, the payment, the cash flow, that's what really matters the most. And again, so we have another example here. So interest rates are higher, but so are home values. And so they actually ended up doing this 3 points to buy the rate down. So it's not really that much more than the current with doing a second mortgage, but their payment is $367 a month less. And so they kind of leverage that home equity to try and buy down the interest rate to make keeping the house more affordable. So when you have an equity buyout, that kind of changes the equation. And so it helps to kind of see these numbers and how they line up and to help you make a more informed decision. If you'd like to schedule a call, just click on one of the consultation icons and you can schedule a 15-30-minute call with me. We can discuss your situation a little bit more. I can put together some numbers and shoot these over to you. Thanks.